Again, and we're back. Yeah, so quite a lot of interesting conversations happen here on the interview with me, and I've had the opportunity to have really interesting conversations with great people. Now, today's market volume with this threat of asset bubbles and inflation and the prospect of a growing number of insolvencies, together with the rising scrutiny around the environment, social and governance performance of companies, and of course, the urgency for robust cyber resilience, they're all key risks for directors and officers, or should we call them DNOs? Now, DNOs to watch in 2022 is what we're talking about today. When it comes to board members, company executives, they could be held liable for an increasing range of scenarios. Now, this is where DNO Insurance comes in. Directors and officers insurance provides coverage for a company and its management, protecting them from claims rising from their decisions and their actions. To talk to us a little bit more about this, we have Hazel Ramela. Now, she is the Financial Lines Senior Underwriter at Allianz Global Corporate and Specialty Group, AGCS. Now, she's an experienced underwriter and insurance professional as well. And she's also a property specialist in real estate and a marketing and sales specialist as well. So, quite a long CV we're working with today. And it's a pleasure having you with us this afternoon. Hi, Hazel.
Hi, Titi. How are you this afternoon? And
I'm
thank you
fan-
for having me here. Thank you so much.
I'm fantastic. Now we wish we could see your face. I'm just gonna say, I wish your internet over there could cover this. I know that it would have dragged the audio a little, so it does make sense to have you hide that beautiful face of yours. Uh, but well, there's a lot to
Thank
talk
you.
about. There's a lot to talk about.
Sorry about it. Absolutely. Absolutely.
No,
Thank
no,
you.
there's loads to talk. D&O's insurance. Well, you will you forgive me for saying I hadn't really heard about this kind of insurance before now. Why do you think that is?
Okay. DNO insurance. The full word for DNO insurance would be directors and officers insurance. This is technically an insurance policy that covers directors or key managers, directors and officers liability insurance. This covers the cost of compensation claims made against them by shareholders, investors, employees, regulators, or third parties. This means that our directors could be facing legal suits from all these people that I've just mentioned. It is very broad, so I will try to sum it up. It covers the directors and officers for their specific duties, responsibilities, and powers relating to their positions. Okay, let's start by saying the directors and officers' duties are usually set out in their job description or terms of reference. If a director or officer of a company is found to have acted outside of their duties, then civil, criminal, or regulatory proceedings can be brought against them. So
Hmm.
now this is the way this policy that would cover the cost of defending these proceedings as well as payment costs that arise from unsuccessful defense. So if a case is not successful, but it is could cover the defense cost. And just to go on further, if a director and or officer they don't have the insurance, they face a greater risk of not being able to defend themselves.
Hmm.
And remember now, the process of legal proceedings can drag for a number of years before
Hmm.
they are settled, and thus accumulating huge legal costs. So now
Hmm.
the reason companies have to have this type of policy is because lawsuits are expensive, and it's because of
Hmm.
the costs associated with them they keep rising all the time.
Hmm.
Okay, now the beauty of this policy also is that it covers the past, present, and future directors of a company. So, and this would cover also the individual for the acts performed or omitted while they were in that position in that particular company. So now this means that if an individual director is no longer a board member and a claim is made during the policy period against them, they've left and the claim is made while way back when they were a board member for the alleged wrongdoing as a board member, the policy will still
Mm.
yeah, it will be it will the director will still be covered under the policy if there is an existing policy in force while the claim is made.
Okay. So
Okay.
this I'm really interested in hearing more about this, especially um, since you said it covers officers even if they are no longer with a company. So, for
Mm-hmm.
instance, there could have been some kind of issue or case brought to an officer while they were still in service, and
Mm-hmm.
after they retire, they still could be held liable.
Absolutely. They could still be held liable because there could be maybe a case or a claim could be brought or it could be it could have happened say for an example 5 years back but only discovered 5 years
Mm,
later. So the director has retired, so he will still be covered. And remember now, another thing is interesting thing is that directors can be held liable on their personal capacity, and they can stand to lose all their assets and that of their spouses as well. So hence, it is very vital that a company has the directors and officers policy to
mm,
cover
mm.
them. In the currently for past directors and the future directors. So that's the whole purpose of having this type of cover.
I understand. So I'm looking at the website here, DNO Insurance work. How does it work exactly? I know how basic insurance works. You know, you get
Hmm.
coverage for unforeseen circumstances. Um, Now, you mentioned liability earlier, and I talked about post, maybe even post retirement. And if a suit is filed, for instance, the I understand that the insurance company would be notified. But what is the process exactly from start to finish?
Okay, I think we need to understand more of a cover before we could get into the details. So
Okay.
now, yeah, okay. Let me just to carry on because I would say for a company, they might ask themselves how much cover is enough for a company. Is it
Mm,
how much limits can they purchase? Because now that is also important. Um, I will come back to your question shortly. So now at early stages, companies, this is now for startup companies, they for them it's difficult for them to obtain general insurance cover for more than 3 million USD. So insurers are only willing to give them cover for say 1 million to 3 million insurance. Sometimes, however, younger companies would want this insurance. For example, if ever a high net worth individual on the board insists on having such cover. So oftentimes, however, more limits may not be available. This is because now DNO Insurance want to limit their exposure to bankruptcy risk. So they feel that younger companies have more exposure to bankruptcy. They could be insolvent at any time. So now, so sometimes that is more likely for younger companies than more mature companies with strong operational track records. So now, by contrast, a late stage private company with a large valuation and a lot of assets or revenue is a candidate for buying more insurance.
mm. Mm,
However, latest the companies typically still, some companies they still typically buy 5 million to 10 million in DNO insurance limits because they see it's good for them to have the cover, but
mm.
then they haven't had any claims, any losses. And remember now, the saving cost as well. So only they would now increase the limit should
Mm.
they have an issue or an incident.
Okay. So now,
Okay.
I do see this as the key for um, small, medium enterprises to ensure some kind of longevity, some kind of legacy down the line, because it is said that the average SME may not last up to 2 years before something could happen. And it does seem like risk management is what has affected most SMEs that didn't last more than 2 years. Now, there are the questions that are even right here on your site. A lot of people don't
Mhm.
even understand how a typical DNO insurance program would look. A lot of people feel like they've covered all their risk by just insuring the actual physical assets of the company. They don't
Mhm.
they don't think about it as a necessity to insure the officers, because they go to church, they pray a lot, and they feel like they have all their ducks in a row. There are
Absolutely.
I don't know if am I going too far? Am I being too sentimental with
No,
using
no, you're
this
on
example?
you're on the right track. Now you can carry on.
So
So
go ahead, please.
absolutely, absolutely. I'll start with the small medium enterprises.
Hmm.
Because now I would say absolutely the DNO insurance is not just for public companies. No, is it just for large companies, small and medium-sized companies they do not have shareholders and are not subject to security claims or lawsuits. However, claims can come from anywhere, including customers, vendors, competitors, employees themselves, and even government agencies. So now DNO is designed to cover claims against directors and officers of all industries and sectors, and also includes cover for the company itself. So now you mentioned a program. What does a typical insurance program look like? So programs with limits over 10 million US dollars are usually too large for one insurer and require a group of insurers to share the risk. In this case, the primary or lead insurer will handle the wordings, advise on setting up the reinsurance program, and settle claims. Then the primary insurer provides the primary layer of DNO cover. For example, 10 million, and then once the primary limit of liability is exhausted by the payment of loss or claim, the next layer kicks in. So the next layer will be handled or insured by a different insurer. Let me say AIG would be on the primary, and another company AB would be on the second on the first layer, and then second layer the list goes on, and this can take up a certain amount and so on. As the first policy to respond to a claim, the primary insurer carries the greatest risk exposure. Therefore, primary policy premiums are higher and typically reduce higher up the tower. So it's more like building a cake. The bottom will carry the majority of the risk, and they get a chunk of premium, and then as it goes up the premium reduces, and the exposure as well reduces. There's not much exposure to them, so there's a possibility then that the claims could only end up onto the primary layer. So I'm not sure if you understand me, or are we on the same page? Hello. Okay, let me just carry on. Sorry about that. So another question will be, how can risk management protect directors and officers from the many perils they face in today's business environment? Okay, I will respond to that in effective risk management is a three-point effort of risk identification, risk mitigation, and risk transfer with its overhaul of corporate governance and financial disclosure. Regulatory oversight to private and public companies and their DNOs will lead to increased compliance costs, new avenues of liability, and potential litigation for private and public companies, small and large. Early identification of legal, regulatory, and compliance risks are, as well as complete enterprise wide operational risk management framework reduces the probability of loss. The best defense for DNOs against any potential lengthy court battles, costly settlements, and tougher fines and penalties is loss avoidance. So now in the event that losses occur, their early identification mitigates their ultimate severity. So one would also ask, what are common DNO risk scenarios? So I'll just mention a few. So now the first one will be the breaches of fiduciary duties owed to the company and shareholders. Now, when you have a business and you put a great deal of trust in your partners, managers and employees, and when someone breaches that trust, it can be very costly for your business as well as an individual. For an example, sharing an employer's trade secrets is damaging the goodwill of the company. And also inaccurate reporting can have a painful and costly consequences on a company. So those are a few examples of breaches of fiduciary. And another example of DNO scenario could be the shareholder actions. You see now the shareholders have financially invested in a company and have interest in the success of that company. They have the power to take action when their interests are at risk. So now the directors of a company would be the first to be sued by the shareholders for any breach or any for any losses or any wrongful advices that may have given to their clients. So now another one, I would say I'll just give this last one here, the reporting of errors as another DNO risk scenario. You know, with the companies, they pressures to match the financial expectation is one of the reasons for financial reporting errors. As we all know that companies, private and public, they have to be audited on yearly. So now any errors that they may give the auditors could be held against them, and it could be a lawsuit against the company for those errors. I'd say that it is very important that customers purchase good value, good insurance product, especially a very good DNO policy. Value is driven not only by the price, but also by the quality of that product. Clients must be able to trust that, insurers will provide them with a quality product. Usually, as an insurer, the clients our clients will be the brokers, and the brokers' clients will be the company directors and officers. So basically, what we're saying is that they really have to try to have to be able to trust that in the process of obtaining an insurance policy for them, that the insurers will definitely provide them with a quality product that delivers on reasonable expectation of performance. And clients also have to trust the insurers to deliver fair value and treatment. One would ask what and who is covered and what is not. The DNO policy would cover the directors and officers while performing their duties and responsibilities, or their company or organization, the company itself, if they are being sued. The DNO insurance claims are paid. They're paid to cover the losses associated with the lawsuit, including the legal defense fees. What is not covered? So basically, this cover excludes fraudulent or criminal actions. So now, if a director or an officer commits fraud within the company, could be misusing the company funds. This cover is a specific cover to cover such losses or such incidences. That would be a commercial crime, but or depending on the type of industry, we have commercial crime and we have financial institutions crime. If it's a bank or an investment company. So they would have a specific policy that will handle such cases, such covers for the directors. But this one is a different one. So that is what would be excluded over and above. There will be other, depending on the risk analysis, if the depending on what the underwriter found to exclude. In MOC, I'll just mention one typical exclusion, say for state-owned entities. So they're bound to, to sue each other. So the underwriter or the insurer will then decide to include, to add on that insured versus insured exclusion. But under normal circumstances, that exclusion is not automatic. It's never there. So the DNO cover under general would cover directors or managers suing themselves, suing each other, to say suing each other, because that usually happens quite a lot, not necessarily meaning that it's the state-owned entities only.